Welcome to this deep dive. We've got quite a stack of information here looking at different exchange-traded funds, ETFs, Specifically, we're comparing ones aimed at generating income pretty much now versus others focused more on growing wealth over the longer term.
That's right. Yeah, we're going to try and unpack what these sources are telling us about SCHD, JEPI, JEPQ, SPYI, and QQQI. Quite the alphabet soup, but a good mix of strategies here.
Exactly. And our goal today, our mission, is really just to help you understand the core ideas, the yields, growth potential, the risks, too, for these specific ETFs.
Right.
And crucially, we're basing this only on the source material we have right here.
Yep, just the facts as presented in this stack.
So you can see what this particular set of information highlights and, why it might matter depending on what you're looking for.
Absolutely. Consider this our roadmap for the discussion.
Okay, let's unpack the source material then. Maybe start with just a quick flyover of each fund. What the material says, its main thing, is maybe the typical yield from the table provided.
Sure thing. So this information describes SCHD first. Says it's focused on dividend growth from U.S. stocks. And the table shows its typical yield is, well, somewhere around 3-4%.
Okay, 3-4%. That sounds like a traditional dividend approach. Then we've got JPI. The material here says it uses a covered call strategy, S&P 500 stocks.
Yeah, S&P 500. And its yield is shown as quite a bit higher, typically 7-10% range, according to this data.
Interesting. And then JEPQ, similar idea.
Very similar, yeah. The sources say it also uses covered calls, but it targets NASDAQ 100 stocks instead, so more tech-focused. And the yield, typically a bit higher again, 10-12% is what's listed here.
Okay, so JPI, S&P, JPQ, NASDAQ. Got it. Now, the material also lists SPYI, covered calls again, S&P 500.
Right. SPYI is also S&P 500 covered calls, but the typical yield mentioned here is pushing up around 12%.
12%, okay. And the last one, QQQI, let me guess, NASDAQ covered calls.
You got it. NASDAQ 100 covered calls, and again, the table in our sources shows a typical yield around 12%. So right off the bat, you can see this material presents quite a spectrum, right? Different yields, different underlying stocks.
Absolutely. A clear range. Okay, so those are the basics from the table. Now, let's peel back the next layer this material gives us. It talks about regular income potential. This seems pretty key.
It really does. And based on this data, SEYI and QQQI, well, they clearly offer the highest monthly yields right now. Both are sitting around that 12% mark we just mentioned.
All right.
So the sources position them as, strong contenders if your absolute main goal is just getting the most income immediately, like right now.
But there's always a but, isn't there? The sources seem to add a really important point here.
They do.
They specifically note that the growth for SPYI and QQQI is minimal, or maybe even non-existent.
That's what the material states, yes. Minimal or non-existent growth. And it points out this means not only might your initial investment not really grow, but maybe more critically for the long term.
Yeah.
The income you get might not keep up with inflation over, say, decades.
Oh, interesting. So that high yield today might lose its purchasing power over time. That's a really crucial piece of info from these sources for anyone thinking long term.
It absolutely is something to weigh. Then you've got JPI and JPQ. The material describes these as providing, high, pretty steady income, still using those covered calls.
Right, the 7-12% yield range we saw. Yeah. JTPI on the S&P, JEPQ on the NASDAQ.
Exactly. And the sources mention, as you expect with covered calls, that strategy kind of caps your upside, right? If the market really takes off, you don't capture all those gains.
So you're trading potential big gains later for that higher income now. Makes sense.
That's the trade-off described, which naturally brings us to SCHD.
Right. The odd one out in terms of starting yield.
Definitely.
The material highlights its lower initial yield back at that 3-4% level.
Correct. But here's where this material suggests things get, really interesting, particularly if you're looking out, say, 10, 20 years.
Okay.
It emphasizes SCHD's strong dividend growth. Historically, the sources mentioned over 10% annualized growth in the dividend itself.
Whoa, okay. That seems counterintuitive at first glance. A 3-4% yield outpacing a 10 or 12% yield over time. How does the material explain that works? Can you walk us through the mechanism described here?
Yeah, it really boils down to the power of compounding as the data lays it out. The sources suggest that because SCHD's actual dividend payment per share has historically grown significantly year after year, that 10% plus number your income stream isn't static. It gets bigger.
Ah, so the income itself grows.
Precisely. Think of it maybe like a snowball rolling downhill. It starts small, but it picks up more snow, gets bigger and faster.
Okay, I get the analogy.
So over a 10 or 20-year period, This material argues that growing dividend stream, especially if you reinvest it, means SCHD's annual income payout can actually grow to be more than the income you'd get from those high starting yield covered call ETFs.
Even though they started much higher.
Even though they started much higher. The sources are pretty explicit in making this point about SCHD potentially overtaking them in income over the long run.
Huh. So what's fascinating here is just how clearly the sources lay out that fundamental trade-off. Do you want the biggest possible paycheck from your investment today? Or do you want an income stream that starts smaller but has the potential built in to grow much larger over time?
That's exactly the dilemma presented.
Yeah.
Maximize today's cash flow or focus on growing future income and total wealth.
And that leads us perfectly into what this material discusses next, right? The whole growth and long-term wealth angle.
Yeah, logical next step.
And reading this, the information seems to clearly position SCHD as, well, the preferred option among these five if your goal is total return, that's growth plus income, and specifically growing that income and wealth over the long haul. We're talking 10, 20 years out.
The sources definitely lean that way. They back it up by citing SCHD's historical total returns annualized somewhere between 9–12%, according to this, combined with that really strong dividend growth we just talked about.
Right.
And it's that compounding effect where hopefully the share price grows and the income stream itself grows that the sources say leads to much higher total wealth and higher annual income over those longer time frames.
Okay, so that's the picture for SCHD according to this material. Now, how does it contrast that with the covered call group JEPI, JEPQ, SPYI, QQQI?
Well, the sources are pretty blunt here. They state that the potential for the principal to grow in these funds is limited. It's inherent in the covered call strategy itself.
Because they're selling off potential upside.
Exactly. They are, by design, according to this material, trading away some, or potentially a lot, of that long-term capital appreciation. That's how they generate the high current income from the option premiums. It's the trade-off.
And this material doesn't mince words about the likely outcome over, say, 20 years.
No, it's quite explicit. It states that over a 20-year horizon, SCHD is likely to surpass these covered call funds. And not just in total portfolio value, but also in the actual annual dividend income being paid out.
Wow. Both value and income.
Both, yes. Precisely because of that compounding growth mechanism in SCHD that the covered call funds largely lack, according to these sources.
So the distinction seems crystal clear based on this information. You're choosing between maximizing the income check you get now or maximizing your investment's future value and potentially its future income stream.
That sums up the core difference highlighted here.
Which naturally makes you think about the downsides, right? What are the risks? And the material gets into that in the risks involved section.
It does. For SCHD, the sources list the usual suspects for a stock fund. You know, general market risk. If the market tanks, SCHD is probably going down too.
Standard equity stuff.
Yep. It also mentions potential sector concentration. The examples given here are energy and industrials being potentially significant weights at times.
Okay.
And dividends can be cut. The material notes that, especially in a bad recession, though it also implies SCHD has a good track record. But, and this is important, the sources also state there's no cap on SCHD's potential upside if the market really booms.
Right, unlike the covered call funds. So turning to them, JPI, JEPQ, SPYI, QQQI, what risks do the sources highlight for this group? It seems like a different set.
It is a different set, mostly tied to that option strategy. First, they call out option risk. Like we've said, because they sell calls, the strategy itself limits your gains if stocks soar way past the strike prices. You miss out on those big upward moves.
Okay, the capped upside risk, what else?
Then there's income risk. This is interesting. The sources state that if the market goes flat or even down, the money they make from selling those options, the premium might decrease.
Ah, so the income isn't guaranteed to stay that high?
Potentially not. If option premiums fall, the income these funds can distribute could drop too. So that high yield might fluctuate downwards in certain market conditions, according to this material.
That's important. High yield isn't necessarily stable yield.
Could be variable. Then there's growth risk, which is specifically highlighted. The sources mention that for these covered call ETFs, your actual initial investment, the principal, might just stagnate or even decline over time.
Decline, really?
Yeah, the material notes this is maybe particularly relevant for QQQI and SPYI, the ones with the highest yields, possibly because they might be more aggressive in how they sell options, potentially sacrificing more principal stability for that yield.
Okay. Risk of principal erosion. Anything else?
Just one more specific point. For JEPQ and QQQI, the NASDAQ-focused ones, the sources mention sector risk. Because they're heavily concentrated in technology stocks, that can mean more volatility, more ups and downs, compared to a broader fund like one tracking the S&P 500.
Right, tech can be a wild ride. So this risk breakdown really clarifies why these funds behave differently. It's not just the yield, it's the whole mechanism and the risks that come with it.
Exactly. Different engines, different potential problems.
And thankfully, this material pulls it all together in a summary section, which is helpful.
Yeah, it tries to synthesize the key takeaways. We should probably recap those based only on what's summarized here.
Good idea. So for maximizing immediate income, like cash flow right now, the sources point towards SPYI or QQQI, highest current yields listed.
Check. Then, for what the material calls a more balanced approach, trying to get decent income but also maybe some growth potential, it suggests GPI or JEPQ fit that bill.
Okay, the middle ground, sort of.
Sort of, yeah. And then, for the person focused squarely on long-term income growth and building overall wealth over decades.
Let me guess. SCHD.
That's what the sources conclude, yes. They present SCHD as a superior for that goal, offering what they describe as a better blend of safety, that growing income stream, and long-term wealth potential.
And they specifically mention the inflation risk again.
They do. They explicitly call out SCHD as having less risk of its income stream being eroded by inflation over many years, precisely because it's designed to grow, unlike the potentially stagnant income from the high-yield, low-growth options.
Right, and the summary reiterates that the covered call ETFs fundamentally trade away long-term growth for current income.
Yes, and that they might underperform, potentially significantly, in strong bull markets compared to something like SCHD over the long haul. That's the trade-off emphasized throughout this material.
So the bottom line, just drawing directly from this stack of info, if you're looking out 10, 20 years or more, and you want regular income that actually grows over time, this material suggests SCHD is the better fit among these options.
That's the conclusion presented here.
Whereas the covered call funds like SPYI, QQQI, JEPI, JEPQ are better suited if you absolutely need to maximize your income payment today.
Right now, yeah. But the sources warn you run that risk of missing out on potentially substantial long-term growth and maybe even seeing the real value of your income shrink over time because of inflation, given their limited growth prospects noted here.
It's a really powerful distinction laid out in this material, isn't it?
Very clear trade-offs described.
So what does this all mean when you step back? Based purely on the sources we've walked through today, it seems the best choice among these ETFs really hinges on a fundamental question for you, the listener. Is your priority getting the absolute maximum income right here, right now? Or are you playing a longer game, aiming for growth over time and an income stream that hopefully gets bigger and bigger down the road?
The sources definitely frame it as a choice between those two paths, a clear trade-off between that immediate high yield and the potential for future appreciation and that compounding income growth.
Which brings us to maybe a final thought, something for you to mull over based on this deep dive. The sources repeatedly mention this risk of income erosion from inflation over decades, particularly with the high-yield, low-growth strategies.
Yeah, that point comes up a few times.
So the question to consider is, how might that specific risk the potential for your income's buying power to dwindle over 10, 20, 30 years? How might that influence your own long-term income planning and the choices you make?
It's definitely a crucial factor to weigh, especially if your time horizon is long, based on the picture these particular sources paint.
Indeed. Okay, that's our deep dive into this specific set of source material for today.